Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding, sitting next to Geoff Gannon. Jeff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great for everybody else as well. If this is the first time you are tuning in with us, be sure to hit that 5-star button wherever you are listening or watching us. Hit the subscribe button. Follow me on Twitter. If you're interested in our money management services and you're a qualified investor, reach out to me, Andrew at focusedcompounding.com. So what's today's date? Today is December 21st. Wasn't this the day the world was supposed to end? Remember that whole thing? December 21st, they made a movie about it. Yeah, I don't know. Something like that. But it's December 21st. It's before Christmas, before the end of the year. But I thought it would be good to do a recap on 2021. Okay. And the reason I want to do this is because
this is dangerous.
20 years from now, when we're looking back and I'm thinking about early on in my career, I'm going to be like, what was I thinking in 2021?
Okay.
What was the end of that year like? And I thought it would be cool, over time. I think we'll be thankful that, or maybe not thankful, but, maybe we'll appreciate having what we were thinking about in the time and just kind of throughout our journey. So 2021, let's see. Could do a little bit of a post-mortem and then maybe our thoughts going forward. Okay. It was the year of meme stocks, which,
right.
So I guess that kind of happened a lot last year as well. But GME, that was actually at the beginning of the year.
Okay.
It feels like it was a 2020 event or a very long time ago, but that was in January of 2021. Tesla, all these other meme stocks. We had the Archegos blow up. That was a big affair that happened.
Wow, that was this year.
Wow. Yeah. China.
China happened.
China happened. China regulated the education system, which kind of started this spiral on Chinese stocks in general, Alibaba, which actually we're going to record a Q&A. Somebody, a friend of the podcast, Vetla, asked about your thoughts on Alibaba, which we'll wait to the next podcast to talk about that. The S&P currently, now we don't want to front run anything, but the total return is sitting around 24% year to date. The 10-year yield is around 1.47%, which is up from just under 1% at the beginning of the year.
Oh, really?
Doesn't feel, I know, I had to, when I went back to look what the 10-year was trading at the beginning of the year, I would have guessed it was kind of around where we're at right now. It was like 0.9, something like that. It was under 1%. So that's kind of some of the big things that I thought throughout the year. I'm sure there were many other things, but it was really just a year of, I don't know, it was just a year, right? Like they had the same craziness that you get sometimes in stocks, like with memes and stuff like that. Of course, the big news throughout the year has been inflation, which we've talked a lot about, I would say.
Nominal growth in general.
I
can't remember, well, I certainly can't remember because I wouldn't have been alive, but I can't think of any year in which, I'm using the end of this year. So actually I should say like annualized and stuff, and it wasn't necessarily the beginning. But if you do like GDP now and things like that, you get an idea of what I'm talking about. The actual nominal growth rate at this point, annualized with inflation and real GDP both being so high, the total amount of growth in dollar terms that everyone's seeing is pretty much unprecedented for the United States. Actually, as of the time we're recording this, the United States, I'm sure, will have, for the quarter, like as of right now, will be growing faster than China.
So what are you, as an investor, I always like to bring this back, like to what does the individual investor do? I mean, so how are you sort of thinking through these things for your own process when you're sifting through ideas?
So we think longer term. So like, the fact that things will be good for some company next year is not really, we don't buy a stock on that basis. There's plenty of stocks, plenty of companies where I would say you've got an idea that things will be good next year versus this year and versus the year before. But we try to pick things based longer term, which means mainly having to be a somewhat reasonable PE for a business that we like, an industry that we like, management that we like. And so that's gotten harder, because I would say that stock prices in general have kind of gone up faster than I would say the underlying earnings have gone up.
Everyone's playing their own game. Our game is different than other people's game.
Right.
So when I say stuff, I'm not critiquing anything or anybody. I do feel like in the companies that we follow,
right,
the ideas are sort of more few and far between, as
Right.
opposed to other microcap investors that I follow on Twitter, social media, blogs, stuff like that. They're saying, holy cow, there are a ton of microcap opportunities right now
Okay.
because the sell-off has just been pretty brutal in that group.
Yeah. So I mean, I guess I kind of misspoke in that way.
Could that be just the type of companies we're focusing on?
Yes.
Tend to be a little bit...
It's a
I don't want to critique. I'm not saying
rotational.
anything.
It's a rotational thing.
Everyone's
We've talked
playing
about
on
this before. Yeah, it's a rotational thing. I have no idea why it happens that way, but it does. There's things that should have gone up last year, did not, and now they go up this year, and I don't know why, except that it has to do with certain characteristics of investors preferring certain kinds of things. So we tend to be a little bit more of the quality, right? So like a better balance sheet, more of the whatever you want to call it, quality things that people invest in like big stocks, but applied to smaller stocks. And so there's less of that with somewhat more speculative or whatever kinds of companies. And we aren't in certain industries that would be a little bit harder hit or whatever. So it's just there hasn't been as much shift away from those things. I would say, yeah, the S&P 500 is a little misleading compared to sort of the median stock, right? So actually it's not very broad based, the increase in stock prices this year. Although I don't know that a lot are down a lot to levels that we would care about, because
that's the thing. A lot of investors could look, again, not passing judgment.
Mm-hmm.
I'm just saying what's kind of out there right now. Oh, this stock's down 30% or something. But
right.
we would look at it and be like, okay, it's down 30% from the peak on the stock chart. But where is that from a valuation perspective?
Right. So, I mean, it matters to us, PE for most stocks, sometimes price to book or price to sales when we're evaluating stocks that we think have more of like a normalized sort of, their earnings might be somewhat cyclical. Margins might be cyclical. Returns on equity might be cyclical. So that's what I care about. And I would say generally, there's not a lot of stuff that's very cheap. There may be some things that have come down a bunch in price. And I did say before, like there's certain categories that I don't know enough about, and so can't say. The biggest one of that is like fossil fuel energy stuff. Some of it might be cheap, but I don't know how to evaluate it.
I had that down on my notes because you did mention that in the last podcast. That you think a lot of stuff fossil fuel related is pretty cheap right now. Or yeah, I think you said it's been surprising to you where it's currently at.
Yeah. I guess so. Yeah. You would have, I would have thought that you'd see that go up more given the sort of economic data that we've had and things like that. We've talked about that before. That sometimes you have ideas about what sorts of stocks might go up more than others in anticipation of certain things. I guess you would say some things that should be very sensitive to certain earnings things, certain economic things that we're seeing. You would probably expect people to buy financials and energy things. Just in general, they're not as high compared to certain other things in the index, or as high as a percentage of the index, and they give you some exposure to some stuff that if people cared about the like medium term or something, that they would benefit. That's not what we do. We don't look to like own different kinds of industries throughout a cycle. But if you were doing that, that's the kind of thing that normally at that point in a recovery early on, that's the kind of thing that you buy. But I haven't seen as much. Of course, it has recovered. I mean, when I'm talking about fossil fuel things and stuff, it's recovered. I just meant compared to the price of oil, it actually isn't more, a bunch of these aren't more expensive. Mm-hmm. They've recovered only in line with oil prices.
Mm-hmm. So a day after we recorded last week, the Fed basically announced that they're going to speed up their tapering process from 15 billion to 30 billion. And that, I mean, you were kind of, I guess you said you were kind of shocked or whatever. It was interesting to you in the car ride over to recording today. You said that Powell basically came out and said, yeah, inflation's here, or it's running hot right now.
The actual content was exactly what was expected. I was impressed or whatever by the candor of the press conference. Yeah. Because it's a little, it's blunt enough for them to write headlines about. Usually you kind of, when talking to the press or whatever, don't give them, you don't like to give them quotes that they can take out of context and put, and you don't like to give them good headlines that sell well, headlines that people will click on. So, you don't want things like Powell says inflation high, or whatever. You say is relatively more elevated than it was on our previous,
yeah, it's like, let's give a long title so it doesn't perfect, it's not a perfect quote.
Yeah.
But also that, to expect 2 to 3 rate hikes next year as well. So tapering slowing down, interest rates going up. We've talked about how now more than ever in your career, this macro theme is very important, you said, or you're thinking about it a lot. So how do you sort of inject that information, and how are you thinking about that, like, going forward?
Well, I'm not making predictions about anything. You just have to be careful, because certain businesses may be exposed in some ways to risks that you don't want to take. Primarily being a mismatch with borrowing short, lending long if rates move very quickly or something like that. And sometimes with inflation things for some companies, there could also be issues there. So just, businesses that are very affected that way. For large S&P 500 type companies, usually they're pretty diversified across some things, so that doesn't matter as much. But for some of the companies we pick, if you have a business model that's very reliant on one thing, sometimes you're not set up for an economic situation that way. We like a lot of very focused businesses, but that does mean that you rely on one sort of kind of economics, which that business model can be affected by things like what we're seeing now. Sometimes beneficially and sometimes not,
I'm kind of curious. I mean, is there any main lessons or takeaways that stand out to you from 2021?
No, I didn't do a lot of buying or selling of stuff in 2021. And I don't think there were large amounts of results for stocks and things that we had that weren't largely luck based, the timing based and stuff about why they fell in one year, not another. Yeah.
So what do you mean when you say not luck based? Meaning like this is just stuff that you kind of foresaw?
I didn't predict the level of growth, nominal growth and things that some of them would have this year and the effect that would have on companies. And for some of them, it's very positive when that happens, but I didn't predict that. So for instance, even in some cases where earnings were up a bunch or something, then I wouldn't give myself credit for that because I didn't foresee it. It wouldn't have been reasonable to foresee it ahead of time. But, on the other hand, luck cuts both ways. There also, you have to look at your own portfolio and decide with those sorts of things. I try to do the best I can to, not, to separate decisions that you made from things that were not that you would have been able to foresee that way with luck. But sometimes you get lucky with a stock in terms of the multiple expands or something. Sometimes you get lucky that the earnings expand for reasons you did not foresee.
Sure. So
as an example, this is a stock we do not own, didn't buy, whatever. I wrote up A-Mark Precious Metals, if you remember, and basically said, I can't predict what it'll be and whatever, but it's
the ticker AMRK, I believe.
Yeah. There was a business that they had that I thought was pretty steady. I thought was pretty good. And, I'd said whatever, like it could account for $8 of value or whatever. I forget what it was at the time, it was like a $10 or $12 stock or $11 stock. And so I said, so it's a fairly low price for the speculation, but that's not what I do and everything. Well, someone might have bought on that, on the idea of the speculation being that basically it's a market, effectively what I was saying is it's like a market maker in the physical metal. So
we're talking about 2019 as well.
Yeah. So when the spread happened, before this happened with COVID. So the spreads, the volatility of things like gold and silver, so they're in gold and silver, but gold in particular, were very low for a few years. So it was reasonable to expect that returns on equity would go up at some point. This kind of thing. It was just unusually not volatile. So that would be reasonable to expect that, right? But if someone bought the stock reading that and said, okay, I'm going to buy the stock because this is a good decision that way, and then COVID happens and the stock goes up 10 times, 5 times or whatever, more than 5 times, I guess. That's luck, right? But if they read that and then during, what was it, in the early days of, let's say early days of lockdown stuff.
So around $8 to $9 a share.
Okay. And then a few months later, what if you see, at what point were they seeing a lot of speculation in the market and things like that in stocks and all that? Then maybe they could make that bet. But of course, the math at that point isn't that great for the stock. If you're wrong, then, you paid a slightly high price, I'd say, if you bought it, 15 or 20. But maybe it would go up to 50 or whatever it turned out to be.
In your write-up, you talked about, though, if gold shot up over time or something, like this company would benefit tremendously from it. I mean, I haven't read the article since 2019, but you did basically said, like, this could be kind of more of like an intelligent speculation, I guess.
Right. But it's sort of like...
You could read on Focus Compounding if you want.
It's sort of like when I said that I had once done a thing. People asked, like, did I ever send something to the Value Investors Club? And I said, yes, that I did one time for something, which was an ethanol thing. Short one ethanol company. And
it's a related hedge.
It was a company that was electronic stores that were selling them off and getting into ethanol and trading below book. And then it was another company, a popular ethanol company that had the name ethanol in its stock name and stuff, that was trading at many times book. And so the idea was you buy the thing that isn't, it'll change its name eventually, you short the other thing, whatever. The lucky part of that, of course, so, the lucky part of the other one did fine. So the one that I said to go long outperformed the market or whatever, that's fine. That's not so much luck. The short going down a lot for valuation, okay, that's fine. The part that would be completely luck and you couldn't predict it is it was so bad that it went into bankruptcy and stuff, So that
it's like I think you could have predicted that it actually turned out to be a fraud.
So that's something that's all luck that way, right? And I think that's true with these meme sorts of things, right? If you were in GameStop because it was a value stock and then it took off and it made a bunch of money that way, then that's purely luck, obviously.
Luck's an interesting topic and how it plays into investing, because lucky people continue to get lucky. Winners win. So it's almost like when you say like it cuts both ways, it's true. So you take that situation. Right. Sure, it was luck where you couldn't foresee it going into bankruptcy, but you put yourself there. Bit. Yeah.
I mean, you knew who was running it and you knew what the craze was.
I guess you could have picked other companies to short and you picked that one, right?
Right, but that one just because that was the most irrational views by investors in it, right? That was the most bubbly.
I'm just saying you're not buying Zoom at like a gazillion time sales.
Mm-hmm.
So I don't know. I get there is luck to these things, but it's true. I mean, lucky people that just continue to get lucky, and there's a reason behind that.
Yeah, I think it's important to separate out the factors that drove your performance in a given year, or over a long period of time, usually, or evaluating a single stock over a long period of time and decide whether what you think you were right about and could have foreseen. And we talked about that with resulting and all of that. I think it's both for an investor, it's both you can put too much into luck when you start looking at like the statistical things that academics look at and what they see in it and whether it's statistically significant of different things. They often, I think, overestimate how much luck there is in certain things that way, just because it's very difficult to prove these things to statistical significance when we're using it and trying to find like some, so basically what you end up doing is you're trying to find some statistical thing in factors and things that basically explains the kind of investing Warren Buffett does. And what he does is close enough to that you're explaining something, but it really, you're only kind of getting at, what he does. So I think that goes too far. But on the other hand, thinking that you're completely responsible for the stock performance because of the decisions that you made is also not the right way to think about it. So I would try to separate them out. And like I said, for a bunch of things that we bought or whatever, I think there was a significant luck component to actual earnings and results. I don't think that we got lucky at all in terms of multiples. Things that we owned did not have multiples that expanded relative to earnings that much versus other stocks. Mm-hmm. We didn't have luck in terms of people being attracted to the stocks that we had and bidding them up a lot and stuff. That really didn't happen. Instead, it was business results that were somewhat harder to predict. And usually there's an element that's, Well, like a good example, we've mentioned someone had asked about car dealer things before, so I mentioned Virtue Motors. Virtue Motors is an excellent example because it's very weird what happened there. So a thing I couldn't predict, if you look at it, is do you have the most recent price? Okay, so $67. 67 pence, sorry. Remember, they're quoting it. When you see that, it's pence, so that's actually 0.67 pounds normally is how stocks are quoted in the UK. So I wouldn't have been able to predict that earnings would go up a bunch. So it was earning like 6 pence a share at that time or whatever, probably, before COVID. And so it seemed reasonably cheap. I think I said on the podcast, maybe it was at, 4 times normal EBITDA or something. That was a lot of UK car dealers were like that. So anyway, what happens is basically they're probably going to earn for the year, I would guess, a 15 pence or something like that, right? So it's still at like 4.5 times PE or something, whatever it is. So the actual, price to book has expanded a lot. And so in that sense, buying at a low price to book and then it goes up, okay, that makes sense. But the actual investment thesis in a way is completely wrong because I expected it to buy back some stock, pay a dividend, and get revalued, basically, right? Well, it's actually been revalued at the same multiple in a sense. But on a normalized basis, I think the multiple, is higher. I think people realize that it's not going to stay earning what it's been earning recently. But, it was, you buy a stock at 5 times P or something, it'll go to 10. Instead, earnings tripled or doubled. Mm-hmm. And the multiple didn't, right? And so you have to look at that and say, what did you earn it from? What part of it? And that part was luck that way, yeah. I would like something like, I did think that Virtu would grow a little bit, as an example. Not a lot, but a little bit. But it's really good to find a stock that you feel like the business will grow, 7% a year or something for 10 years while you own it, and the multiple will double or triple.
And do you think the multiple follows that, though, in some off the beaten path type of stocks, where if the returns have just been solid, predictable, the actual has grown over time, people start to notice? It
does, but as we pointed out before, sometimes we've gone back to show different stocks and things, and like we did looking back at J&J Snack Foods, no, like it did fine in 2010 and 2015 and whatever, but it was doing about that in 2005 and 2000. Like it just did longer and got to be a bigger company, but it had the same sort of economics when it was smaller. Well, we had an experience with computer services, right? So you saw that firsthand. Why did it re-rate? I don't know. So it re-rated to more of like a high quality stock on a public major listed exchange, more in line with its peers.
Competitors, yeah.
Yeah. I don't know. So that's a good example with the luck thing. If people had asked me to pencil in what is my exact predictions for revenue growth, margins and stuff, I would have hit it like perfectly for computer services. But if they'd asked me what will the PE be, I wouldn't have gotten it right. So that's, in a sense, you could say that's a luck part. I would say the luck was the speed of it, right?
Sure, yeah.
So I would not say it's luck to assume that it ends up with a higher multiple over time. A high quality company eventually will get recognized with higher multiples. If you pick a business that's in line with other businesses that have higher multiples, eventually that's what happens. That's part of what being a value investor is, and we should assume that. We should not buy assuming that a 5 PE stock will always stay at a 5 PE. All the time I buy things that are those low PEs that I think are really high quality, and eventually they'll trade just like any other stock in that industry. But we can't control the speed.
Yeah. And that's why if you underwrite it over 10 years, which we've talked about, or 5 years, 5 to 10 years, and it happens in year 1 to year 2, that's when you get that huge IRR. But to your point, you can't really predict that.
Yeah. So Japanese stocks I invested in, very lucky in terms of how quickly the timing happened. At other companies, I've said like I would say you have to kind of count luck the other way. Of like I owned George Risk for a while. It did about the same as S&P 500 during that time. Business performance was good and in line with what I was looking for, and nothing happened with the stock. Basically, it didn't choose to pay out some big dividend. It did sell itself off. It didn't buy back stock. Could you have predicted that? You could have predicted that might be the most likely outcome, but was it a 55% chance? It wasn't a 95% chance. So you always have to take into account the other luck element, which is that something you own could have been bought or something, So sometimes it works the other way in terms of luck. I'm sure there are people who owned, like say owned Cambria or something, right? In the UK. And then you got kind of unlucky if you were taken out, probably now at this point, because look what happened with Virtu, right? I would guess that if it hadn't been bought out, we don't know because, you don't have the numbers for them. But I would be surprised if the stock was trading at as low as what it was taken out for. And it was taken out within the last year, So you got unlucky in management taking you out. But I'm sure there was a pretty good chance that deal wouldn't have come together, and you couldn't predict that.
Do you think a good way for people to focus on just the business results itself is to do the owner's earnings?
Yeah,
spreadsheet and just kind of keep track.
Well, I like
that.
the look through earnings thing. I mean, personally, I know other people hate that redoing it that way. But in my view, if you really own these companies and believe in it, you should not, when looking at it on a continuing basis, you should not mark your portfolio concentrations, your portfolio allocations to things and how much you're exposed to them in terms of the market price. You should use the earnings. So, in other words, if you own 100 shares of something that's earning $3 a share, your actual exposure to that is $300 of earnings a year, and you should think of it that way. And if the multiple doubles, but you're still sticking into the stock, you should not think that you're twice as rich now, right? Now, it's perfectly okay to use market values when thinking about should I sell this or should I buy more, but otherwise, I would not use market values. I would always look through, and that's the thing with Buffett. What he's mostly talking about is things that Berkshire will continue to hold. That's the part of the look through earnings I think people kind of overlook. He talks about, buy the things that if you hold it for 10 or 15 years are most likely to give you the best look through earnings. He's not saying that's the way to think about things, his workouts and things from his partnership years. He's saying because we're going to continue to hold this, you really shouldn't focus on the market price. You should focus on the earnings and what they're doing. And over time, that's true. If you're going to hold these things, if you're going to, knowing the price of Virtu is very important if you plan to flip it in the next year or something. But if you plan to own it for a longer period of time, what matters is the earnings this year, next year, each year. And that's really what is going to determine your long-term results in the company, because that's going to determine its dividends, it's going to determine its buybacks, all of those sorts of things. So I would definitely stick to that. And I know people adjust it for the market thing that way, but I think it's would be really bad idea to think a stock earned the same amount of money, it dropped 50%, let's say, relative to your other stocks. Your other stocks went up a little bit and this one went down a little bit. So now you own half as much of it in your portfolio. I don't think that you really do. You have the same amount of look-through earnings on it. Yeah. If earnings went away and stuff, then that's different. But your real exposure to stocks is through the earnings part of it. In the long run, that's what matters. I've said that before, that stocks may be revalued because the discount rate changed, but you don't revalue your job, your salary based on a change in the discount rate. You don't say, oh, well, now it makes sense that I value my job twice as much now because, I'm making the same amount of money, but it has the DCF has completely changed here,
Outlook for 2022. And maybe not an outlook, but just your thoughts going into it is just continuing to slug away and do what we do.
Yeah. Exactly that. My thoughts are, for me personally and stuff, it's mostly to try not to force something. It is very difficult, especially if you have cash, and not that we necessarily have a lot of cash or whatever, but it becomes more difficult if you have any cash, and as you get more cash, it becomes more difficult. If you have a lot of borderline things or not a lot of good ideas, that's when you make really bad mistakes. Yeah. You can see that with Buffett, and sometimes where he's had problems. That definitely having a lot of cash and having high prices in the things that you're looking at can cause you to make mistakes. But I've said many times, the level of stocks overall does not matter one bit to me in terms of whether I would buy something or not. So
what does that mean? So
if I find a stock
trading at?
If I find a business tomorrow that I really like and it's an acceptable price to me, I will buy it really regardless completely of what the overall market is. I'll never change allocations on things just because of what the overall market is. I would only do things because I literally can't find something, But if I find something that I like, then I would buy it, even if I think the market is incredibly overvalued. And likewise, if I thought the market looked really cheap overall, but somehow I wasn't able to find things, I don't know how that would happen. But if that did, then it wouldn't change things. You'd have the same sort of approach that way in terms of a specific thing you're going into. I always look around like, each deal one off that way. If it makes sense, and it makes sense in any environment. We've talked a little bit about macro things. What we really mean about that, though, is just specific risks to companies and things, that way. So, like, if say if you own some business that somehow would do really badly if inflation was too high, then it doesn't mean you should sell it or whatever, but you would be worrying about it going into next year or whatever. Although it's very possible inflation has peaked on an annualized basis or whatever, but it's just more likely that you would have some of it as a consideration. It's something that you can consider. Those kinds of macro risks. Not just like the stock market is expensive. I would never not buy stocks because the stock market is expensive. If it's something that makes sense, then we would do it. And so I'm always looking for things that way. And trying to spend more and more time looking for specific stuff and spending less time thinking about things more generally,
So specific stuff like specific ideas as opposed to
specific companies. Yeah. That's always the case. That's always the best way to solve those things. I mean, I never have any idea where I'm going to find something. Really. It's not, very rarely has ever been like, this category of things seems cheap, and then you look into it and you find something. Occasionally that has happened. But very, very rarely. It's much more that you're just looking at one thing after another, and then you find something that makes sense. And I don't know why, it's not all that expensive or something at the time when you find it.
Well, it's kind of bringing it back to that whole luck component, right? Like, sure, you don't know where they come from. You don't even know if they're going to come, but you do know. Well, it's like, hey, we've gone this far. It has worked out.
One of my favorite sayings is Peter Lynch saying that you turn over the most rocks, then you're gonna, that's the person who will find the most good stocks. And I think that's absolutely true. And one of my absolute favorite books is There's Always Something to Do. Mm-hmm. Yeah, and I think that's true. I think that's absolutely true. But the thing that happens is it's sort of like other people's experience with OTC stuff. I know that people don't like OTC stuff because you look through a bunch of garbage to find a few high quality stocks, and you'd rather look through the S&P 500 where in a sense it's all been vetted for you. Each thing you're going to see is going to be a good company. Some might be way too expensive, but they aren't pump and dump type stuff. Well, for me, that issue is that if you have an expensive market, what happens is you say you're doing a 10K a day, right? You can spend all month and have one thing that you're really interested in, and that's all you need. Mm-hmm. But it is difficult in expensive markets that what happens to people is it can be disheartening or whatever to pass on so many things.
Yeah. Depends how you look at it.
Yeah.
If you look at it like you said, well, I'm just turning over rocks. It's part of the process. But yeah, we've talked about before how, you really think the hit rate is 1 in 100 at least.
For what you mean, for finding something that I want to buy?
As many rocks as you're turning over.
Yeah.
Looking at 100 companies, and some probably harder than others, until you find something that you're like, yeah, I could see us actually owning it.
I mean, of all publicly traded companies and stuff, we are probably talking about, it's got to be 8 out of 10, 9 out of 10, just our businesses that I don't really want to own. Now, you could say at some price would I own them? Yeah, if they were net, if they were available for almost free, I bet that would be true. But do I want to own this, be in this industry, be in this stock on a longer term basis and stuff? No, 4 out of 5 stocks, probably not, to be honest. And then in markets like 2009, that actually turns into a bunch of stocks that you can buy. Mm-hmm. But in markets that are a little bit more like today, if also 4 out of 5 stocks are kind of expensive, then, 1/5 of 1/5 is a pretty small group that we're talking about now. Mm-hmm. Now we are talking about you're looking all month to find one idea that is kind of, the price is kind of okay and the business is kind of okay of what I want, And you have to remember all of this is circle of competence. There's, for other people, things that they can do that I just don't understand as well. And so it has to line up. And sometimes it does, and you're lucky that way, that the things that are cheap are things that you understand. And other times there are things that are cheap, but I don't understand them that well. And so, that happens sometimes.
When people bring ideas, and I know like kind of instantly if it's something that we could be in, just from like the business perspective, I think people would be surprised. Like in my mind, I automatically think about like the position in the industry and what that industry looks like. So take out the business, profits, cash flowing abilities, everything like that, price. I just kind of visualize like what is the industry like and what is that company's position in the industry. So really competition, stuff like that.
Yep.
I think that'd be surprising to a lot of people.
Yeah. And there's a phase where you have to try to keep a really open mind. I've talked about this, like, I don't know, people are like, how long does it take you to know whether you're interested in a stock or something? There's a thing where you try to be, that at the end, or I know that at the end, there's a really small circle of competence. There's a really small amount of stuff that's close at all to the line of that I'm going to buy it. But you need to start, when you don't know anything about it yet, you need to be willing to consider it, even though you think the surface says this is probably going to be filtered out. But there's some stuff that there's reasons why you might filter out, but then when you really learn about it, then you realize, oh, this is actually very like things that I do understand, and so it's okay that way. And because I'll say like, yeah, I have to understand the business and stuff, but then I bought a company that made nuclear reactors. Right. So to most people, that's not a simple business. Right. So your first look at that is, I don't know. I mean, defense things, this is complicated, whatever. But then when you kind of like look at it and think about it and whatever, then you might buy it. And there are lots of ones like that, where that happens, that it just on the surface would seem that way. Unfortunately, like looking through the pink sheets, if I think on the surface that it's probably a definite no, in the first 30 seconds, 95% of the time, that would be absolutely correct. If you think it's probably a no right away, it is going to end up being that. But you have to try to keep your mind open in considering it. And I do try to do that and try to force myself to do that. And do all sorts of things to focus on that. One of my favorite things to do with that is to look at a specific thing, a specific stock, like lists of them, and take that one thing and look at it. And I like to use pen and paper and write notes on it, circle things, whatever, try to have a bit of a conversation with it. Actually read the 10K and mark it up. That's my best thing for that process, because then you're really engaging with it. You're taking it seriously if you do that. What I try to avoid is like when I talk to people and they say, I kind of read that blog post that someone had about it, or that Seeking Alpha thing or whatever, or I found it on a screen, or I looked at the financials, that's fine, but I don't like just like people looking through a list. I just saw the PE or I saw whatever and I eliminated it from consideration. You try to keep at least open enough mind that you learn about it.
Business models.
Yeah, the business models, and see if like some stuff is way off. I've done all sorts of tricks of trying that to fool myself and stuff. Like, I found something, I went, oh, this is really interesting and all that. I think I said that, and it was a software as a service thing. So I thought it'd be expensive, but it was a whole nother kind of expensive when I realized what the price of it was going for. So, but I thought, oh, this is a company that we could buy. Because most of those I would think no, but as I'm reading about, I'm like, I can see the strengths here and why people, and all that. So at least that way, that. I don't know if that's a stock like that will ever be cheap enough that we'd be able to consider it or whatever, but you learn about some segment of the industry, and maybe it's useful later in life to have known that. There are some companies that, are high flyers and then they get cheap, or companies that are sort of popular for a little while. We manage to own computer services, and the truth is that mostly the core processors that were, the bigger ones, always traded at premium Ps and stuff. So it would have been easy for me to eliminate them and not learn about them and stuff. So it's helpful to have already learned about things like that when you could find something that's smaller.
Is that something that sticks out to you maybe? It would jump out at you automatically if you knew this was an industry that trades at a premium valuation like the larger ones, and then you find a similar company that, you know, has great economics and everything, but it's over the counter.
It's tricky because it depends on how they describe it. This is why you want to read the 10K and mark it up to try to really understand it. Because if you read the business description of a lot of companies, they're not always that good at describing a business in terms of what I really care about and I really understand it. And sometimes, in fact, a company has a significant moat or whatever you want to call it, and that doesn't come across in the business description, or it's pretty much simpler than it seems to be from that description. It makes it sound more like a, you know, highly technical sort of thing and stuff now, and that's not necessarily how it might have made itself sound a while ago. I don't know if that's true, but, you know, if it focuses a lot on talking about predictive analytics and all of those sorts of things and different things about that, then that's not easy to figure out. Obviously, people know about the FICO score and stuff. If it describes that and it describes how many major institutions use it and stuff, then, you know, it would help out in understanding it. But it's not always easy to know that, especially if you're not in the industry, to have an idea of the advantages that some company would have. You know, you kind of have to understand that. It's easier with the big, like, really, you know, that's why people want to own, not necessarily want to own, but something like Coke or whatever is the first thing that comes to mind, right? Whereas, like, owning See's Candy, if you've never been to California, right, is just as good as owning Coke. But you had to work a little bit harder for it. They had a nice connection with Munger, with knowing so much about California and everything. So you could do a little research that way. But sometimes you can figure out those things and you just see it in the numbers. So I try to do that. If the description of a business sounds really interesting, but the numbers don't, I do try to push myself to, okay, explore this. And if the numbers look really interesting, but the business description doesn't, I try to do the same thing. I don't mean cheap price and stuff. I mean, look, it's been earning 30% on its capital for 10 years or whatever. I need to look at it and try to understand it, because from the description, I don't understand how that's possible.
So that's something that would jump out to you. So, okay, you're sifting through some stocks. Do you put them in QuickFS, and then from there you say, I'm just going to read the annual report? Do you build a list? I mean, what's your process like from that perspective?
So I like to immediately take note of it and then go back to it later. So what I actually do, like with QuickFS is a good example, I actually do take a screenshot of it to go into my screenshots. And then those will later, I'll go to those and pick it out to put together a list from that. Okay. So if I'm going through things, let's say because someone's talking about it or I read about it in an article or something, I put in the ticker, right? But I'm going to go through a few in a row, right? So someone's writing up, you know, banks in Alaska or whatever. So I'm going to get 2 or 3 tickers or whatever. So when I do that, I'm just going to take screenshots and put it aside, and then I'll go back to that later. I like doing that. The same thing with like blog things and stuff. I will print them out and save them for later to focus on it then. Yeah,
one thing about Geoff, and I think you would say the same thing, you don't multitask.
No.
Everything you're doing is dedicated or strictly what you set out to do. So if you're looking for stocks, you're not gonna kind of casually look and then maybe look at the annual report while doing. It's like, no, like the time dedicated to doing something is what you're doing.
Yeah, and so I have absolutely no problem with screens and stuff. What I have noticed is like the way that some people seem to use screens and some other sources and things does worry me a little bit. Like I don't think it's a great way to do it, which is look at it for, I don't know if you're even looking at it for 30 seconds, but you're going through okay, here's the screen. And then I go to QuickFS and I look at it. Does it look interesting? No, next. No, next. That one, that's okay if you're doing, like I said, like, okay, take a picture of it and put it aside, you know? If you're doing, you know, if you say you're going through Barron's or, you know, whatever, so you actually had a hard copy of something, then, you know, literally circling it. Or let's say with, you can do with, what is it, Rome research, right? You can take things and throw it in there, you know, for later. So physically you can put it in a folder and go back to it or whatever. I don't like the switching back and forth thing with a superficial level and then a really in-depth level. There's nothing wrong with I'm going to read a whole 10K, put it down, then I'm going to read a whole nother 10K and stuff. And there's really nothing wrong with like exhaustively going through a screen. I've done that. You know, it shows up like 50 things and then you really go through and look through every single one. The danger is like you find the first shiny thing and then I'll go read that 10K and you never look at anything else. You know, the one that bothers
like you want to like close the book on it, move past it, go to the next one.
The one that kind of is strange to me, I'll say.
Grinds your gears.
Is strange to me is when I talk to someone who like has learned about a stock, likes it a lot and whatever, and hasn't looked at any of the other publicly traded companies that are doing the exact same thing. You don't really need to, it's not like you have to compare them to each other and this has to be the absolute best one. Maybe you're most comfortable with that one. I wasn't so comfortable with Cambria, so we bought Virtu, you know. But you looked at them and you understood the differences and whatever. You try to look at every one that's in a category that way. The reason why that bothers me a little bit is it's like, then I would worry, why did I settle on this one? Okay, did I settle on this one because it was the one written up on Seeking Alpha, or that was in Barron's, or that someone I know told me about it, or whatever? And it depends on, or it was the first one in the screen that I found, or it's the biggest one, or it's, you know, whatever it might be. And some of those things are fine. Like it could be perfectly fine if it's because it's in my local area. That's probably not too bad unless your local area is like New York City or something, because that doesn't really mean that other investors and stuff would be in the same boat as you that way. So you might have some, okay, so it's a totally random reason why you find out about it, but it's not like why everyone is looking at this stock, right? But it's very possible the reason you're looking at it is because like their investor relations is putting out this stuff. And, you know, and then it gets picked up and then it goes on to Value Investors Club and things, and then it's in these other message boards and things and whatever. It seems like you just picked a stock, but did you really pick it, or did it like you passively ended up with it because it's the one that had the most was spread around the most, you know? So that's why you just like look at all of them that way, and it's good practice to do that, and I try to do that. I guess the one thing that's difficult is like what the investing that we do means that really I can't focus on learning a lot about big companies that are so big and so well known that I know we're not going to own them.
So if you find one that's a smaller company, will you go read about the peers if they're way bigger as well?
Yeah. So it depends. I will absolutely. If they're true peers, like competing with them, because in many ways you can find out even more about the bigger ones usually, and it gives you some idea of what probably a smaller one is like. For companies where they're sort of just in the same group, but they aren't really like rivals or anything like that, you know. So sometimes on Wall Street things we like have where we're saying they're peers, but they're really just comparable things, you know. Then those I wouldn't. You know, so like would I look at every bank in Alaska? Absolutely, yes. But would I like look at banks of the same size around the country or something? Not really, no. Because it would be more like focusing on things that do the same, have the same sort of business model, you know, that kind of thing. And that's the kind of thing that you have to work at especially hard when the market is a little bit more expensive or whatever. And because you have to maintain discipline on those things. That's what, like when we say we're value investors, really all that means is that we have some price discipline. I don't really go, let me look at what's the cheapest stocks, find them, which ones are okay, let's buy them or something. We really just what businesses, what industries do we want to be, and what businesses do we want to be, and what managements do we want to be with, and then is it cheap enough that it's okay? So it's just, you know, we're not going to pay 30 times for something, and we just are never going to do that. So it's just maintaining that discipline. That's all that it is. It's not, you know, that's all that it means for us to be a value investor. And it's very easy to lose that when you're in a market like today and stuff. Yeah. But I also don't want to sound bearish, right? Because actually, if you asked like what would be my prediction for next year in terms of like economic data or company earnings things or whatever, it would be very positive. It's just that doesn't matter to me or us or whatever, like we're buying for the longer term. So we're very sensitive to just like what price are we getting? We're not very sensitive to how good a result's going to be next year. So I would be more excited at 2009 prices with prospects of that kind of slower recovery than now with today's prices and the kinds of things that, the kinds of growth that you might see. So that doesn't mean the market won't do great next year, and the economy presumably will do great. It just means that there's unfortunately more stuff that like the business, like the industry, and then it's nowhere near the price that we want. Right. And I found that by far the toughest time to invest. It's happened before, but it's really can be, like I said, disheartening, because if you just find constantly stuff that's too expensive, then, you either think there's nothing you can do, which is wrong, or you think, oh, I have to abandon the old approach that I had, which is also not what you want to do.
Yeah.
You just have to
do it, right?
You just have to realize that the degree of difficulty is 10 times more than it was in a cheap market. Because in a cheap market, there's all this stuff that you can buy, so it just seems easy, and you have to look 10 times as hard to find those sorts of things in a more expensive market. But they're out there. It's just you have to look that much harder.
Got it. Cool. Well, I want to thank everybody so much for tuning in with the both of us on the Focused Compounding Podcast. If this is the first time you are tuning in, give us a rating and review. Hopefully that's 5 stars. If not, please do not give us a rating and review.
You can give us 5 stars and then a negative review. I don't think that the
5 stars only. That's all I want.
5 stars. Yeah. And then you can give any comment you want.
Yeah. Comments I actually do read the comments.
Oh, okay.
I do read the comments. If you're looking at the screen right now, quickfs.net is where we pull all the information from. When Geoff said if he comes across a company that's been, has a 30% return on equity for 10 plus years, he says, how do they do that? This is where he's looking at that data. So go to quickfs.net, tell them that you heard of them from Focused Compounding, and that will help support everything we do on the podcast. If you listen to us often, you know everything I'm saying. Same cadence, same pitch. Go to quickfs.net. I want to thank everybody so much for the support, and we will see you in the next podcast.